Welcome to the New Property Show. I'm Steve McMenamin.
On this show, Steve, Kaz talks to Mike. When is it, or when isn't it, an investment property? Our panel discusses how technology is changing. But first, Laura talks about her business, Go Above Beyond.
Hello, Laura, and welcome to the New Property Show.
Thank you so much for having me here. It's such a delight.
Okay, we are going to talk about memorable experiences and gifting clients. What is it that your business does?
Yeah, I think starting off with the name of my business, it's called Go Above and Beyond, and that just goes through every single thing that we do as a business that we want to offer to our clients so that they can give to their clients.
And what sort of things typically are they receiving?
Yeah, so what we really like to do is to change up a little bit everything that's happening in corporate gifting at the moment, and specifically real estate gifting. Previously, it's all generally been some very generic things that are given, one size fits all. And what we really like to do is to do things a little bit differently and to make things a lot more customized. And by that, we don't just mean throwing a few logos on the goods. We mean really taking the time to understand the recipient, and we lean on the real estate agent who has the connection with their client to tell us a little bit about them, and then we will tailor on a one-to-one basis the gift for that person. So it really has got a special personalised touch. And
is it typically a bottle of champagne? Is it some cheese boards? What are they getting?
I'm laughing. We're generally moving away from that now. It has been the cheese board, whilst it's popular with some people, we still continue to offer it for people who want it. But we're moving away from that bit now. It's been done quite a lot. And even on your point with champagne and alcohol, there's been a massive trend, specifically post-COVID, where people have just wanted, where a lot of people aren't drinking alcohol anymore, and we're moving away from that.
I think a nice gift is always nice anyway, no matter what it is. But so talk to us about how you work with agents. So you do some logos and some branding and sort of stuff, but I think it's also just comes in the wrapping that you're putting together as well. So what does that look like?
Yeah, there is certainly something special about having a fabulous unboxing experience. We really like to use all the senses. So even just from the visual perspective, a sheer delight of having something that is visually appealing. We use different textures and different layers within the gift packaging that has that really nice kinetic feel. And then also using aroma through the beautiful candles that we use, or diffusers and things like that, that really make it specific and make it different for the real estate agent, because we're helping the real estate agents grow their brand and grow their presence and set them high so that they can go above and beyond. But really, at the end of the day, it's also about the recipient. We're moving towards having a more personalised, a more customised experience, and now in 2024 and beyond, we're not just any old. The recipient isn't just any old number. Do
you feel that a customer's more likely to stay around had they received a nice gift? Does that help as well?
Yeah, look, there's a massive amount of neuroscience that goes behind the gifting, and it's something that we as a business have taken really seriously and have educated ourselves on, so that we can then pass that through to our clients who are the real estate agents, so that it helps them develop their relationships with their clients for ongoing referrals, for also repeat business as well.
Love it. And what's the maximum someone spent on a gift with you?
Oh my goodness, we have done gifts up to $10,000 plus per gift.
What's that, a car?
No.
Yeah.
Look, and we start anywhere from $60, $70.
It certainly went beyond.
Right.
Yeah.
I know, above and beyond.
Fantastic. So basically what you're saying is your business caters from anyone from entry level through up to the $10,000 gift, and it's not about necessarily always the money that you spend, but it's about the experience that you create. And obviously, it's quite a significant purchase if it's a $10,000 item. But really, really cool. And what advice, just before we wrap up, what advice would you have to somebody that wants to get in the gifting business themselves? Do you think it's profitable? Do you advise other people to start up their own businesses, or just leave it to the experts?
Yeah, look, there's always room for there's room for everyone. I would certainly say if you want to set yourself apart from a lot of the competition, make sure that you are going along a more personalised, customised line and figure out ways to be able to incorporate that within your business, so that you can offer a customised service to the real estate agent, who can then give a customised, personalised experience to the recipient, because that's where the real estate agent, which in effect is the gifting company's client, is going to get more value from you.
Love the name, going above and beyond. I think you should do that in all aspects of life. But thank you for being such a great guest on the New Property Show.
Thank you so much.
Mike, welcome. Thank you for joining us.
Thanks, Kaz.
Mike, you're an accountant.
I am.
And you get all sorts of questions every day.
Absolutely.
Some interesting, some not so interesting.
A lot of them.
We specialize in rental, and we've got investors that work with us all the time.
Yeah.
One of the questions investors also look at is there's a process. So we start by buying a land, say if they're doing a house and land. If they just buy a land and sit on it,
Yeah.
how does that work? Is that an investment property? Can you do deductions? How is that?
No. So with a vacant piece of land, the ATO is pretty clear that unless you have an occupancy certificate and you've got a dwelling or a residence on it, which is earning you income, everything before that point is non-deductible. It's capitalized, which basically means it adds to the cost of the land. So if you buy the land for $100,000 and you spend $15,000 on interest, council rates, blah, 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 your land ends up costing you about $120,000, right? And when you sell it, you can use the $120,000 against whatever you sell it for to work out the profit.
Okay, so it's not advisable to just sit with the block of land.
I don't know if it's advisable or not, but the law is that you have to capitalize the costs.
Sure. And when they're sort of investing in the land or any property, can they take the money from their current loan if they've got equity in there? Can they borrow from there, and how does that work against their taxes?
Brilliant question. We get this a lot. The problem with borrowing from a current place of residence in order to use that deposit towards a new place of residence makes that part of the loan non-deductible. So in other words, to give you an idea, let's say your house, you've paid down the house to about $400,000 and you want to extract a $200,000 on top to put towards the deposit to your new home. Because you are going to live in it and you're going to call it your main residence and you want to take an exemption on it, that $200,000 becomes non-deductible. So what we find happening is a lot of clients coming to us where the loans have increased and they've moved out. So what we end up doing is asking them what was the original loan of the house and how much they've borrowed to put to the new property. And we have to then work out a manual calculation of what is deductible and what is not. So we find that this is one of the biggest misconceptions or misguidances that either the brokers are doing or somebody else is coming up, but please speak to your advisor.
Okay, excellent. That's good, Mike. And a lot of our clients, and in the, I guess all around Melbourne, we have a lot of immigrants, a lot of immigration happening.
Yeah.
And a lot of the investors are from overseas.
Correct.
Many of them are calling Australia home.
Yes.
That's new land. But a lot of them have investment properties from where they've come, from back home. So what would your advice be? Is something they don't have to pay tax here for those properties? Do they include that in their portfolio? How does it work when you look at it, an investor's tax structure at the end of the day?
Yeah, that's another fantastic question. So with Australia having so many immigrants who come from overseas where they were living in their houses, then they now rent it out, and they are either paying tax in that old country, in the original country. They kind of feel like they don't have to declare that here, but that's incorrect. Once you are deemed to be an Australian tax resident, then you have to pay tax on worldwide income. Worldwide income means income from all sources from everywhere. If you're paying tax in the source country, you may get a tax credit for it in Australia. Again, this is quite complex. I can't go into it on this segment, but the advice around this is speak to your accountant, declare the properties, especially because now worldwide reporting is coming in, which means that countries are exchanging information about,
Sure.
people owning properties, yeah.
So, Mike, following on from what we spoke,
Yeah.
it's an investment, is a journey on how things go from the whole thing. And when it comes to tax time, everyone thinks it's going to be roses, but
Yeah.
it's not.
Yeah.
Investors in the recent market, I've noticed, have moved away from their property. They've either moved overseas or interstate for better prospects or whatever need be. And they have what's their status with their property here, and where does the capital gains go with that?
Yeah, so that's another regular question that we get. And again, there's a lot of misunderstanding in the market. We recently had somebody tell us, a client, I've sold my property within 6 years of moving out, which means it's CGT free. And I almost fell off my chair, and I was like, "Who told you that?" And he goes, "Everyone knows this." So it's not the case. It could be, depending on the circumstances, right? So the misconception being that if you move away from your house for up to 6 years, it's CGT free. I don't know where that comes from.
So you live in it first and then move away?
Yeah. So there is a 6-year absence rule, and let me go into it in 2 seconds. It was meant for people who moved interstate or out of country for work, right? And then they came back. So in order to give them a bit of a chop out, the government allowed them to rent their homes for up to 6 years and then come back and still have it CGT free as their main residence. That was the rule.
So in that time frame?
In that time
they
frame,
can or cannot have another residence that they buy?
They can not have it.
Right.
All right. The choice needs to be made while doing your taxes. The choice does not have to be made when you're moving out straight away. Right?
Okay.
So long story short, if you are moving out of your house, of your main residence, and if you are planning to rent all the time that you're away from your main residence, chances are that you will be able to claim that property CGT free. However, if you're buying a new house, then possibly may not be able to claim that.
And that doesn't matter whether it's in Australia or it's overseas?
It does, but again, probably not the time to go straight into it.
Yeah.
Again, speak to your advisor. There's a lot of issues around that, moving countries, moving residences, becoming a tax.
Come on, I thought accounts were simple.
Oh, absolutely, yeah. Everyone should do it. Everyone should get a license. You get a license.
It should be easy, but it's not. It's a very complex structure.
It is.
And it's sort of one glove doesn't fit all, so...
Absolutely not.
Yeah,
Yes.
there's lots that goes into it. So you'd always advise, as we as well, always have their advisors and have a good team. That's most important, to have the right investment team with you to advise you through. Mike, one of the other questions is whether it's old or new property, a tax depreciation schedule.
Yes.
And will claim depreciation. Some buy new, yes, might think it's relevant. Some buy a very old property and might think it's not relevant. So just tell me how a tax depreciation schedule works and how does that help?
Okay, so just to begin with, a depreciation schedule leads to negative gearing most of the time. Leads to it. It's one of the big ticket items. What it basically means is that we all know that land appreciates in value. Land goes up in value. Buildings depreciate or come down in value. Depreciation is contained in two main divisions of the tax law, Division 40 and Division 43. Division 40 deals with things which are easily removable, carpets, flooring, door handles, stuff like that. Division 43 is dealing with things which are part of your home, like walls, things which don't move. From 2017, the government changed its rules. Long story short, again, coming to the crux of the matter, depreciation reports are a 40-year report. It's a one-off, and they give you the amount that you can use as a deduction. Very complex rules around it. Again, there are companies that do just depreciation reports for a living, right? And you can find them on Google everywhere.
Yep.
So my advice would be to go get a depreciation schedule. In fact, most of them would answer a phone call and would tell you whether it's advisable to get one. Because if it is an older property, let's say 40 years or older, then those buildings have already depreciated, basically used up its value. So maybe you don't need a depreciation report.
I always still advise, recommend rather would be the word, to say go and get one anyways.
100%.
Because, we always renovate them, make
Yes.
changes, and those are still can be accounted for. So it's worth sometimes, as you said,
Yes.
make a call and have a look because it
Yeah.
all adds up.
It does, and people normally go, oh, it's costing a lot of money, but that is an investment as I see it. That is, again, a deductible
I was just going to say,
cost.
that's a deductible
It
cost
is a
as well.
deductible
Yes.
cost. So I don't think it's that much of an outlay. So you should get one.
And very quickly, while you're talking about deductible costs, when people buy a property and it's not been leased out yet, and they make changes and things to it, the cost done prior to somebody moving in, is that still taken as
No.
part of the investment expenses?
You're wading into some tough territory here, Kaz. I didn't expect any less, but the quick answer is no. You have to capitalize those costs.
But it's my investment property.
That's right. If you don't have a tenant and if you're changing things around, let's say, for instance, you've lived in a house 30 years and you want to put in a new kitchen, right?
Yep.
Because it's not rentable. And you decide to do that before the tenant moves in. Generally, that would be part of the depreciation report.
Okay.
Okay, you get the quantity surveyor, but normally they're capitalized. Capitalized meaning they add to the cost of the property, not as a part of your rental deductions, which is a different
Gotcha.
thing. Rental deductions are one part, and then capital gains is another part. So, yeah, I hope that makes
Excellent.
sense.
Yeah, because there is properties you take on and then you manufacture growth, make it, like you said, livable or rentable. And something that, if I wouldn't do that, it couldn't be habited and couldn't be leased out as it is. So that would be a expense that they can use towards that. So just wanted to clarify that, sort of that it's capitalized, not a deduction.
Yeah, not a deduction if the tenant is not there. If you're doing everything prior to the lease being signed, generally, and I'm saying this generally, it would not be an expense that you can deduct against your rental income, right?
Excellent.
So you do have a fair amount of people asking me, oh, what about if the tenant moves in and if I do everything after the tenant moves in? Again, it's horses for courses. We can't just put a finger and say black or white, yes or no. You have to see what's been done. Is it a repair? Is it like improving the value of the property? So there are all these things that we need to wade through before we can give a proper answer. So I obviously can't, say yes.
Yeah.
So it all depends. This is the thing in accounting. It depends.
Get a professional, sit down on the table, get to the
Yes.
drawing board and chalk it out for yourself. And one of the other very floating around bits, and it's like conversations over a barbecue or whatever have you, is go negative gearing, it's better. Go positive gearing, it's more cash flow, or neutral or whatever.
Yeah.
Which is right, which is not. And then I'll move that on later on, so tailor it for me in a way into what's right, whether it's for an individual or set up in a trust or a company. How do you, so negative gearing?
Okay, so you've asked a fair, wide, you've touched a lot of points in that question. We can't go into each and every one separately.
Negative gearing, why and...
What is it?
Yeah, what is it?
In very simple terms, negative gearing means a property is losing you money, all right? And because that property is losing you money, the government allows you to use it as a deduction against your other income, right? Why would they do that? They're not silly. They are hoping for capital gains in the future. So they're allowing the property owner to grow their wealth, and when you sell that property, they want a part of that as capital gains. So this is the way properties keep on going up. And this is the way that the government makes sure that, it is still good enough to invest in as an asset class, properties. So negative gearing, just to bring it back a little bit, if you've got rent of X, your expenses are more than X.
Yeah.
Okay? The two biggest ticket items there are the interest on the mortgage that you pay for your rental property and the depreciation. So those two itself would combine to be 70% of the costs, 70% of the rental income, right? And the balance is all council rates, water, insurance, body corporate, land tax, all that sort of stuff. So that actually brings your property into negative territory, which is why we call it negative gearing. Yes. So a lot of people do it because they've got big salaries and there's no real way of bringing it down other than to invest, right? So
this is good and more relevant when it's you bought it in your own name. How does it sit in a trust
Yeah.
if someone's bought in a trust or
Okay.
super or?
So broadly, if you own a property in your own name, you can use the negative gearing against your income, right?
Right.
In a trust, if there is a loss, you cannot use that loss against your other income. Basically, it gets trapped in that trust, the loss, until such time that you make a profit. And then you
So
can
the
write
profits can be distributed, but
Yeah,
you're
correct. Yes. A trust basically only can distribute profits. It cannot distribute a loss.
A loss.
So if you are going to purchase a negatively geared property in a trust, just be mindful that you may not see the value or the outcome that you want for a few years till the property becomes positively geared or gaining you money. Yeah.
right. Excellent. Thank you, Mike. That's a lots of insights. A couple of tips you would give to anybody thinking of investing a property.
Yep.
How should they structure it? What should they look for before they go ahead and sign off on something?
Right. So the biggest tips I give all my clients is, number one, to get a real estate agent who pays for everything from the management.
That will be me.
That would be you. Somebody who, so what we find in majority of the cases is people lose their deduction notice, they lose land tax notices, they lose council rates, they won't even know where they paid the water from. So during tax time, it's almost like pulling teeth and finding out the information. So that's one. So get your estate agent to pay for all your expenses, and that
Outgoings,
will
yes.
come as an annual report to us, which is fantastic. Two is, if you are going to borrow money, make sure that you try and separate the loans per property. If you've got 3 properties, try and make the loans, in line with those properties. People obviously, use money from different equity sources.
Yep.
And then we've got to work out, which loan is for which property. So if you make your accountant's life easier by, making sure that you write down which loan is for which property, that's gonna, they might give you a bottle of wine. I don't know, because that is very harmful to our health in order to calculate manually. So that's the second tip. And obviously the third tip is, if you are going to do renovations, if you're going to make any sort of big changes in your house, and you're thinking you might be able to claim everything, please speak to your advisor first and make sure that you don't have the wrong impression.
And you go and buy something and then you think that's not going to work how it was planned.
Yeah, that's
Yeah.
the other thing that I can't help with that. But if you do speak to your advisor, I could probably say 90% of the time they'll give you the right advice, and you will be clearer in the direction you want to head into for your property acquisitions.
Excellent. Thank you very much, Mike.
All right, guys, welcome to the New Property Show. This debate and topic, it's really open for interpretation, is technology. How has technology changed? We were discussing this off camera. You probably still drive around with a Mailways, or we're talking about using Google Maps. How do you
something
think?
to do with my haircut.
You're only 37. How has technology changed your industry, and what do you do?
Yeah, so my business is DASCX. We help businesses to bring AI
Yeah.
into their business
Yeah.
because everybody wants to use the technology and stay ahead of the competition. So it's all about having that edge over your competition. Where we come in and show them is how you can go that extra mile of automation with how you do your business. So for an example, we work with a lot of property managers. So the property manager's biggest limitation is how many properties they can handle without expanding the team. So what we do is we look at what they do on day-to-day basis and help them to automate some of those things so they can manage more properties. So that's just one example. And we see a lot of people nowadays seeing the value of AI and all beyond ChatGPT. They're like, okay, we want to make sure that we have tangible benefits. It's not just ChatGPT and Midjourney and things like that. They're like, okay, how is that going to impact my bottom line? How I can make my team do more? It's more like that's what they're asking us now. So that's how we see that whole industry transitioning now.
So it's making not only people more efficient, but you're getting more return on your investment. So it's combining people and technology, and not everyone has to think that AI is bad. Look, there is some limitations to it. I think that obviously it still needs to have an overriding factor. But Zach, you've built up a bit of a property portfolio yourself, but you were in Sydney for a while, now you're up in Queensland, but you'd have to use technology as a young kid to essentially have bought a few of your properties. What sort of tools do you use to make before you make an informed decision to buy a property?
So technology is playing a big part of how I choose the property that is unique to my portfolio. So the 3 platforms that I use that are very important to me is RP Data and Google Maps, realestate.com, sometimes Domain, but with RP Data I can always pull out the information of that property from when it was built to when it was purchased and to when it was passed down to another owner, how much is getting rented at, how big it is, and all the information that you require before purchasing a property.
Could a young investor get access to that nowadays? Like can
That's
anyone
correct.
subscribe to RP Data?
Correct. So most subscribers now, you would have to be a real estate professional to sign up, but a couple of years ago, I've just signed up as a property investor without an ABN, and I've just took full control of it. I was paying $200 a month, but it was giving me all the tools before I make that deal go through, before I sign that contract of sale. That property had all the data on RP Data.
Bet you a few people get a surprise when you go in and you know more about the property than they do.
That's correct.
And it can be used to use the advantage. What about you, Rory? How do you use technology now? Because you're running quite a large firm in terms of I guess funding. How has that helped you with efficiency?
Yeah, hugely. I mean, I think like most industries, real estate or mortgages has really changed through technology. We've got different areas of our business, and just we're in different states. Just the communications is so much easier. The credit teams use AI quite a lot now, so we're certainly getting used to that, and their decisioning is becoming much quicker, much more predictable. So we see it right throughout our business, and in our property advisory team especially, as you're touching on, but the data points that you can get now on property and on areas is insane, and you can get it at your fingertips, which means that your speed to decisions can be much faster, and you've got some data to back up what you're actually doing. I think that we try to have a balance between the sort of feel but also technology. But having that data at our fingertips just means that we've just got a lot more confidence when we're talking to clients about history of properties, history of areas, and where we think the market's going.
And your systems too, obviously, let's go back to the money side of it for a second, are making very quick assessments, because I do know brokers out there that pretty well mirror a bank. They'll, before doing a credit check, they'll essentially they'll test the deal, and they won't submit it till they're at 100%. So. Are you at that skill level yet, or are you just?
We're probably not testing it to that level, but we certainly run credit checks that don't show up obviously on files, so we're not affecting credit scores. We are, we've got a back office team offshore, and they're basically an experienced credit person who's running through that. So there's still some of that human touch to it, but we're trying to put technology right throughout the business, because it just makes it easier for us and more efficient, so we get a better client outcome. So we're probably a little bit off, that back-end bank system, but we're certainly on our path.
Do you think maybe then, just adding one more part there, so sometimes the issue with technology is we don't know how to use it. Do you think you would almost consider on your next hire, hiring somebody that understands how to utilise AI, and could almost like a Dasun sort of coming in, but you almost need to now hire for an expertise, because it's really just about the keywords and how to do that. But your business could still tune up a little bit if you hire the right staff member that showed you how to use those tools. Would that be something you might consider in a hire moving forwards?
Be a massive advantage to someone who came to us saying that they have that expertise and that skill, would be a massive advantage. We could deploy that knowledge right throughout the business. Absolutely.
Well, hopefully one of our viewers watching comes and works for you.
Absolutely.
Reach out. There's always a seat. And that's all for this week. Thank you for joining us. If you want to see the full interviews, check out our website, and we'll see you again next week.